Donald J. Trump's swearing in as the 45th President of the United States made official a reality that was totally unexpected. It also highlights the challenge investors face every day. How do you invest in a world where you don't know what will happen next? The answer is actually pretty simple. This chart illustrates how investing strategically by diversifying and rebalancing helps shield a portfolio from surprises, and it's based on what actually happened in the stock market in 2015 and 2016. Our hypothetical portfolio is diversified by investing equally across 10 industries defined by indexes from Standard & Poor's. For the record, a portfolio comprised of only S&P 500 stocks is not very diversified. It's missing bonds, real estate, commodities, and many other asset classes. But the 10 industry indexes illustrate how diversification works. In 2015, looking at the light blue bars, the worst performing sector was energy, and 21.1% of its value was erased. In 2016, energy did an about-face and was number one in the 10-sector race, gaining 27.4% in value. Rebalancing would have meant buying more of the biggest loser of 2015, energy, for instance, to make up for its diminished influence. The second and third biggest losers of 2015 were companies in the materials business and utilities. They also bounced back very strongly in 2016. Rebalancing was a good move for investors in 2016. The discipline would have added more of the battered sectors before they bounced back, enabling a portfolio to keep up with changing times over the long run. Because the unpredictable nature of investing is a permanent condition, both an enduring strategy and discipline are required to cope with it. The Trump administration's first 100 days are likely to bring sweeping tax reforms, a pivotal appointment to the Supreme Court, and the findings of a congressional investigation into Russian meddling in the U.S. election could be announced. Massive nationwide protests followed Mr. Trump's inauguration, heightening uncertainty. However, the outlook for the economy in 2017 is still bright, following the virtuous economic cycle in the fourth quarter of 2016. Unemployment hit a new low. Job openings hit a record high. Real personal income and real consumer spending rose. The forward-looking leading economic indicators remain strong, and monthly purchasing managers' reports indicated strong growth in new orders in the supply chain. While personal income and spending rose, inflation was near dormant, and the Fed remained accommodative. Adding to the bright outlook, personal tax rates are likely to be reduced, and corporate tax reform, if enacted by Congress, would boost corporate profits. However, just because an economic expansion is underway doesn't mean you can't have a bear market. While recessions always trigger bear markets, modern U.S. economic history contains many instances of stock price plunges of 10 or even 20% during economic expansions. At 91 months, this economic expansion is over 2 years away from running longer than the 120-month expansion of the 1990s, the longest in modern U.S. history, and it could keep on going. The depth of the economic destruction wrought by the Great Recession has attenuated this expansion, amid nearly dormant inflation. Evidence of new global expansion is growing. The Standard & Poor's 500 index closed on Friday at 2271.31, not far from its recent all-time high, which it reached in early January. While the bull run is backed by economic fundamentals, investors could change their minds fast, particularly if something unexpected happens. A double-digit correction could occur at any time, particularly in a climate of political, social, and international change. However, major news events, good and bad surprises, have occurred over and over again. Despite these events, the world economy continues to make progress, which has been reflected by the rise in stock prices since the economic expansion began in April 2009, which could continue rising. Do not hesitate to contact us to be sure you are rebalancing your portfolio properly in preparation for the unexpected changes ahead.